Wonderful. The usual disclaimer, don't make any financial decisions based on this. So just obviously with what could be a complex subject, just to get an idea of knowledge in the audience, can we put hands up? Who's heard of investment funds? Fantastic. And who has heard of ETFs? Oh, look at that. Wonderful. Okay, who has heard of active versus passive investing? Brilliant, brilliant. And who here is a do-it-yourself investor? Look at this. Wonderful. I'm in the right place. And who here uses some kind of financial advisor, wealth manager, or a private bank? Okay, great. So many more DIY investors with some good level of knowledge here. That's great. Fantastic. Okay, so we're all familiar with Morpheus from The Matrix. What an impressive character he is. And I'm sure everyone will have seen this meme on and off many times for 20 years. But it has a new message here, which I don't need to read it to you. You can read it for yourself. But he also has another message, because you might read this and think, hold on a second, this sounds a bit, this sounds a bit Tin Hat Brigade. Well, I'm going to prove it to you. In fact, Morpheus is going to prove it to you. So, hence the reason why there may be some technical slides here. Okay. I've called it the greatest financial scandal of a generation. And if you saw the sort of the preamble teaser, the reason that I've called it that is that most financial scandals we hear about because they hit the news, they get discovered, it's a Ponzi, or it's a fund collapse, or it's some sort of major scam, or because corruption. We'll hear about that. But what is almost endemic throughout the financial industry are levels of there's certain things that are happening that don't necessarily help us as a private investor. I won't say any more than that. You can draw your own conclusions as we get a bit closer to that. Before we move on, let's talk a little bit about philosophy. So if you're familiar with active versus passive, then you may be familiar with this. But let's just talk about machines in general. Why are simple machines generally more reliable than more complex ones? And it's actually fairly straightforward. A simple machine has fewer moving parts, so there's fewer points of failure, there's fewer things to go wrong. If it does break, it's easier to fix, easier to diagnose. We don't need expert operators. A simple machine just works. We don't need to pay somebody to operate it for us. We don't need constant servicing, tinkering, resetting, adjustments. All of that kind of simple machines just work. And it gives us predictable performance. Day in, day out, it just gives us what we're expecting. So simple machines in general are more reliable over the long term than complex ones. So let's just keep that in mind. As an example, so I'm a big fan of the Seiko spring drive mechanical watch mechanism. It actually took the guy who designed it 20 years to create, and it's in the top of the range, the Grand Seiko movements. Depending on which source you read, it's either plus or minus half a second a day or plus or minus 1 second a day, which is pretty much in the top 3 most accurate mechanical watches in the world. Now, if you were to let your spring drive watch mechanism run for 300 years, even with 1 second a day accuracy, it would drift by 30 hours over 300 years. You can just multiply through the numbers. On the other hand, here's another timepiece for us. So the world's largest sundial was built almost 300 years ago, and it's still working. Why? No moving parts. It's a simple machine. Well, actually, there's one moving part, the sun, but it doesn't need any servicing. Now, this, the shadow, you read it because it's so tall, this thing here is about somewhere between 75 and 80 feet tall. As the sun moves, the shadow moves, and it moves at a rate of at a rate. And the shadow is blurred, obviously, because it's not a fine edge, but the band shadow is about 4 seconds. So it's accurate. This sundial is accurate to 4 seconds. Okay? 300 years ago, it was accurate to 4 seconds. Today, it's still accurate to 4 seconds. So, simple beats complex for reliability over the long term. Pretty basics. Okay. Right, so let's bear that in mind. Let's get going. Passive versus active. Okay, so for all of those who've heard of passive funds, this won't be any surprise to you. For those who are approaching this subject first, I'm just going to give a quick introduction. So passive funds is the big thing in investing, and it's been growing for many, many years. In fact, this chart, so it's North America, and overall, so as of last year, the overall market for investment funds was 27 trillion US dollars, and as of January last year, now 50% of investment funds are passive compared to active. Okay, what does that mean? So I'm having to learn how to juggle these two. Okay, passive funds. Very, very quickly, we've all heard of indices like the FTSE 100 or the S&P 500 or the ASX 200 in Australia. They're in the financial news. We hear them in the news headlines. And basically, they track. It's an index that tracks a basket of stocks chosen often because of their size, sometimes because of the industry sector that they're in or the geography. But it's basically an index. And a passive investment does nothing more than track that index. It tracks the performance of that index. So, for instance, I could buy an index tracker that tracks the S&P 500 or an index tracker that tracks the FTSE 100 or whatever. And whatever gains or losses the index delivers, my investment fund will deliver the same. Pretty much, less some costs. Okay, so ETFs, exchange traded funds, are a type of investment fund that happens to be listed on the stock market. A lot of index tracking funds happen to be ETFs, but not all of them. So a lot of people use ETFs interchangeably with index tracking, and they do overlap, but it's not always the case. So I'll use, generally speaking, index trackers or index funds as a kind of catch-all. So index trackers are basically investing on autopilot. We don't need, once we bought our index fund, we don't need to make any decision. We don't need to think about it. There's no human decision making involved in the fund itself. It is what it is. And of course, because we're not employing any fund managers, yet they're a lot cheaper than active funds. So what's an active fund? An active fund is just the traditional investment funds, that we're used to. So a typical investment fund is one where the fund managers make decisions. So there's a group of fund managers, some researchers, some marketing people, and they get together and they run an investment fund, and they have some good ideas, and they've got some big brains and lots of PhDs and lots of supercomputers, and they try and create a good investment fund that gives us some solid growth. So these are called actively managed funds, or just active funds in general. Because they have such a big staff and they need to employ fund managers, they tend to be more expensive than passive funds. And guess who pays for that? The investors pay for it. Right, so the problem with active management. Okay, so if you think about it, an investment fund looking after a portfolio, whether it's all the same asset class or whether it's a broad multi-asset portfolio, an investment fund is basically, it's a kind of machine with a lot of moving parts, because at any particular time the investment team is assessing their existing holdings, it's assessing candidate new stocks to buy, they're making decisions about, do I want 5, 10, 15% of this company in my portfolio, how does that compare with others? There's constant interpretation of external economic events. How is that going to affect my holdings? Should I make some different changes? So basically, inside the majority of active funds, there's kind of a whirlwind of constant decision making, of constant activity inside that active fund. So it's a complex forecasting machine, because not only is it a complex machine in itself, but we're forecasting about the future. And it doesn't matter how many super smart fund managers there are, or how many supercomputers we've got. We can't predict the future. We might be able to predict it tomorrow, but once we start looking forward with any length of time, we just can't predict it. There's always going to be things that happen that we don't expect. And remember, the more moving parts in our machine, the more likely it is to go wrong. So the more activity in our actively managed fund, the more forecasts we're making, the more likely it is that some of those forecasts are going to be wrong. And as our observation period extends more and more and more, it starts to become certain that something is going to be wrong. So an actively managed fund is like the world's most accurate mechanical watch in 100 years' time. It's going to break down sooner or later. On the other hand, a passive fund, an index tracker, it is what it is. As long as we pick the funds that we're happy with, we get the growth from the market, we can get on with our lives and not worry about it too much. Okay, there's a very useful site. Who's heard of Spiva, by the way, the Spiva website? Anyone? Fantastic. Great stuff. Google it, S-P-I-V-A. It's absolutely crazy good. So Spiva stands for the S&P indices versus active. They've got loads and loads of data, and what these guys do is they look at the performance of the actively managed funds in the market and compare them against the indices. So don't just listen to me to say that passive beats active in the long run. The data, this is real data. You pulled it off the web last night. So if you look at the USA large cap sector, the index is the S&P 500. So I could have bought an index tracking the S&P 500, or I could have bought one of the dozens, hundreds of actively managed funds that target the USA large cap market. But over 10 years, 85% of those actively managed funds didn't beat the index. So I would have been better off 10 years ago just buying an index tracker and getting on with my life, rather than worrying about what experience has this fund manager got, you know, what's their credibility, what's their strategy, what's their score on Morningstar, whatever. Just buy the index. The same with Europe. So Europe large cap, the index is the S&P Europe 350. 92%, over 10 years, 92% of actively managed funds in this sector didn't beat the index. You buy an index tracker, you get the good results. Same with Australia. And the interesting thing is, so a lot of people say, well, you know, I'm really good at identifying which fund managers are going to, you know, be really good over the next few years ahead. You can't do that with any reliability, because the data says persistency is random. So an actively managed fund manager that was really good in the last few years, it's completely random whether he's in the top 5 or top 10 in the next few years ahead. So the persistence is miserable. Okay, intermission. Any questions at this point? Active versus passive. There are no silly questions. If you've got something in your mind, shout it, because other people are probably thinking about it. Yes, I'd just like to get these questions out of the way, because what we just talked about is so fundamental.
So for a passive fund, what they do is that they buy a portion of all those stocks in the Standard & Poor's 500, for instance.
Correct, yeah. Absolutely right.
It's not like a magic connection. They actually buy a percent of one, you know, a stock of each one of those.
Yeah, there are a number of ways of tracking the index. You can do it by owning, you know, the stocks in the index. And if you look at BlackRock, the reason why they're the world's largest fund manager is because the index tracking funds that they run own all of those bits of those stocks. Thank you for the question. Yes.
So the S&P 500 changes quarterly, correct?
Correct.
So the ETFs are able to absorb those changes?
Absolutely.
Okay.
Yeah. Always track it.
This is more of an observation than a question.
Sure.
But everybody in the world should read Nicholas Nassim Taleb's Fooled by Randomness and The Black Swan, because it makes exactly the points you're making, is that people see this fund performing really, really well for a few years, and then they buy into it. And of course,
Yeah.
but if you've got enough funds, right? If you've got enough funds performing, some of them are going to overperform, right? Just on the sheer randomness thing, and people get fooled
Yeah.
by the randomness.
Absolutely, absolutely. Any more specific questions about active versus passive before we move on? One final one over here. The handsome gentleman in the back.
So, I don't know if this is exactly the kind of question you're wondering, but I've read some things that made me wonder if if the trend is to go more and more passive, who's really setting prices? I mean, the market is supposed to be a marketplace that's supposed to establish the value of companies. So that means there's fewer and fewer people who are gambling and setting the price of a company. It seems to me. It seems to me that it may not, over the long run, be stable. I mean, the long run might be a lot longer than we're here, but I just wondered about that conceptually. It seems a problem.
Extrapolating to infinity is meaningless, because there'll always be what you're talking about is what happens if 100% of the market is passive. It will never happen, because there'll always be people who will do their own thing, and the more and more of the market that gets towards passive, there'll be more opportunities. So there will be an equilibrium. But that's a fantastic topic, but we could literally be here all day discussing that. Yeah. Thank you very much. That's
Just
an
one
important
quick question. Is there, you've used averages and let's say indexing, but what's the reputation, is there a reputation factor of the correctness of various indexers? For example, you mentioned BlackRock and so on. Is there something that tracks how good? There must be a timing factor somewhere, I would think.
Yeah, so good question. An index fund provider is neither good nor bad. They just provide a fund that tracks a specific index. So BlackRock, iShares S&P 500 ETF tracks the S&P 500 as the same as the Invesco or the Fidelity. All of those trackers just track the same index. So there's very, very little difference between all of the different providers. The only difference, ultimately, is the amount of cost between you've got it. Thank you. Right, I'm going to move on. Okay, so active versus passive, we've nailed it. Okay, let's get to the real fun. So a lot of people in this room are already familiar with the active versus passive argument, the discussion, because all of the data, including the SPIVA website that we just looked at, looks at individual single asset type funds. So a fund that looks at Europe, or a fund that looks at the UK, or an index that looks at the S&P, or an index that looks at emerging markets, or whatever. It doesn't look at portfolios, at the overall portfolio. So nobody just buys one tracker and gets on with their life. We buy a portfolio. We'll have a little bit of that. We'll have a little bit of that. A little bit of that. A little bit of that. Okay. Now, when we do that, even if every single fund that we buy is passive, whether it's from Vanguard or BlackRock or Dimensional or whatever, even if every single fund is passive, we're making active decisions about how we put that portfolio together. By definition, everyone in this room, unless they just bought one tracker and forgetting about it, everyone in this room, if you've got a portfolio, it's active because you're looking at it, you're making decisions, you're thinking about it. You are an actively managed machine, for want of a better word. You're thinking about things and making those decisions. That's an active process. And we've already seen in the SPIVA data, over a period of time, between 80 and 90% of actively managed fund managers don't beat the benchmark. Now, if that's true, how can we benchmark at the portfolio level? If we know that simple beats complex, we know that passive beats active, how do we look at our overall portfolio? And this is some work that I've been looking at since 2022. Okay, so let's backstep. So I've got here two portfolios. The portfolio in red, high growth but high volatility. And for anyone not familiar with the word volatility, it's kind of the same. It's the way we measure risk, in inverted commas, in the financial industry. It's the amount of up and downiness. So how much do our investments go up and down day to day, week to week, quarter to quarter, year to year? Because if we're sitting on our retirement fund, we don't suddenly want to lose 30%, if there's a market downturn. So this fund here, this portfolio here is good growth, but fairly high up and downiness. On the other hand, the portfolio here, fairly modest, fairly moderate growth, but very low up and downiness. So this is a low volatility, a low risk type investment portfolio. If there's a market downturn, we're not really going to be affected very much, but the price we pay for that is sacrificing the expectation of better returns in the long run. Okay, so there's another way that we can show exactly the same data, which is this. So this is what we call a risk-return chart. Sorry, because I'm right-handed, I'm using the laser pointer over here. I feel you guys are a bit deprived, so I'm going to try and use the laser pointer over this side. So what we've got here on this axis, the y-axis, is growth, is the return from our portfolio over time. And on this axis is volatility, is risk. So in the bottom left quadrant, we've got low volatility, low risk, but relatively low return. In the top right quadrant, we've got high volatility, but commensurate returns for that high volatility. So this data is showing exactly the same thing. So this could be a 5-year graph or a 10-year graph, but what it's showing is that, as we all know, if we're prepared to accept higher risk in our investment portfolios, we might expect reasonably to have a higher long-term return. Okay, I put this little thing up here just to remind me to just quickly ask very, very briefly, has anyone's got a crucial question? I'm looking at this chart and I have got no bloody clue what's going on. Anyone like that with this chart? No, this is just an example. This is just a discussion point. Yeah, this is not financial advice, sir. You're absolutely right. Okay, let's move on. Thank you for your question. So here is an example of actual. So let me just flick backwards and forwards. So if I go back, here is an actual example. Okay, now this is exactly the same. So, and I've used in this case iShares MSCI World. So it's an ETF that tracks an index of 22 major developed markets around the world, and Vanguard Global Bond, which is an index that tracks the Bloomberg Global Aggregate, which is an index of quality bonds from developed markets around the world. So equities, high volatility, but better gain. Bonds, over the last few years, very low volatility, but very low gains. And we can see that plotted on the chart. So top right quadrant, high volatility, better returns. Bottom left, low volatility, worse returns. Straightforward stuff. Okay, so hands up who's heard of something called a 60-40 portfolio. Okay, look at that. It's one of the ones that's everyone always talks about, but the point to remember about the 60-40 portfolio is it's only one portfolio, but here's an example. So this is the same data. So here's our our global equities, here's our global bonds. If we take 60% of the equity index, 40% of bonds, we've got a 2-index portfolio that is our 60 portfolio. And the blue line represents it. So we've got high volatility, high returns, low volatility, low returns, and something in the middle. Now, if you look during the COVID crisis, if we were totally in equities, we would have experienced a really major downturn. But if we were in a 60-40, we're experiencing, yes, a downturn, but a lot less. So whereas something like the equity only might be appropriate for a young guy, executive in his 20s, don't care what's going on in the markets, if we're a bit more cautious or have a less time horizon, we might prefer a 60-40 because it still gives us acceptable growth, but we don't risk all the downturns at a time when we might be needing to access our money. Okay, so we can draw, just like the previous, we can draw this chart as a risk-return chart. So here we are. Top right, equity only. Bottom left, bonds only. 60-40, somewhere in the middle. Okay, so if you think about it, if I've got a 60-40 portfolio, if I wanted to be more adventurous, I could just increase that ratio. I could make it 70-30 or 80-20. Or if I wanted to make it more cautious, I could make it 50-50 or 40-60. So by adding equity, I go in this direction, or by adding bonds, I go in this direction, or reducing equity. Okay, so just to stress, this chart is showing exactly the same data as this chart. And you can see here, the 60-40 is kind of in the middle, and here, the 60-40 is kind of in the middle. And as we just said, we can change the relative proportions of that 60-40. It's just one portfolio. It might not suit us. We might actually prefer a 70-30. So let's do that. Let's fill in the blanks. Okay, so here we've got a locus, a line that connects 0% equity to 100% equity, and we've got 20, 40, 60, 80% equity. And you can see it's a nice straight line. This is 10 years of data. 10 years of data, volatility along the bottom, so risk along the bottom, returns up the top. Top right quadrant, high risk, higher returns. Bottom left, lower risk, lower returns. Okay, so we've got this straight line. I've got my little reminder up here. Anyone completely lost what we're looking at? Straightforward stuff, hopefully. Yep. Okay, good. Thank you. Moving on. Okay, so just to belabor the point, if I've got a portfolio, so just a reminder, these dots here are actually investable portfolio. You could go online today and buy them because it's iShares MSCI World and it's Vanguard Global Bond. You could buy this portfolio today. You could buy that one today, But if I've got hypothetically a portfolio that plots at this point in the chart, portfolio X, is that portfolio better than my 60-40 or worse than my 60-40? I call it PIPs, passive index portfolios. These are all portfolios of passive indices, so I just call it PIPs for shorthand. So is X better than PIPs or worse than PIPs? Better. Absolutely right, sir. Anything north of this line is obviously better, because if I draw down here, I've got kind of similar volatility to my 40% equity portfolio, but way more gains. So over the long term, I'd have been better off holding X than I would a 60-40 or any version of it. Okay, let's move on. By the same token, you've had your laser pointer time. I'm going to go over here now. So portfolio Y is below the PIPS line. So is that better or worse than investing in 60-40 or one of its versions? Worse, absolutely rubbish returns over the long term. It's only delivered the return equivalent to 20%. So what we're basically saying is, if we plot this PIPS line, a locus of passive index portfolios of these two particular funds, it could be anything, but in this case I've used global bonds and global equities. And I plot portfolios on this chart. If the portfolio plots below the line, I'd be better off doing PIPS. If the portfolio plots above the line, it's a good long-term portfolio. There's something going on there that I should investigate. We all good? Yes. Thank you. Here we go. Right. Okay, so it just so happens, in terms of data, being a numbers guy, I look for data and I want to crunch it. So anyone can go to the Financial Times, you can go to their fund screen, you can select allocation, which is the same as saying multi-asset. Allocation means it's a multi-asset fund. These are individual funds with a mix. So it could be stocks and shares, it could be bonds, it could be property, it could be gold and precious metals, there could be some alternatives. So there's all sorts of different things in a multi-asset portfolio, but we can look. So I just selected those with a 10-year history, and then I just ranked by eyes. So we can see at the top is, I can actually see that, but I know the top is the Vanguard 80%. And this is only one sector. I've just looked at the 60 to 80% equity sector. So we can see these are all £1 billion funds. Then what I did is I just took the data. I'm not going to show you all the slides, but let me just show you the first 5. So the 5 largest multi-asset funds in the UK in this sector are here, plotted against the PIPS line. So I've got Vanguard, I've got Bailey Gifford, I've got St James Managed Growth, St James Balance Managed. There's one missing. Vanguard, Bailey Gifford, Rathbones. There, Rathbones Strategic Growth. So here's the PIPS line, and here are all these funds, and this is 10 years of data. So over 10 years, these are so all of these funds, you know, they're billion-pound funds. Every single one of these funds, I've been better off just buying a 2-index tracker for the last 10 years. Okay, now, a lot of people will be familiar with Vanguard. So why is it, and we know that they are one of the champions of passive, why is it? Because although the Vanguard life strategy range, which is, you know, 40% equity, 60% equity, 80% equity, although the individual assets are passive, somebody is making decisions about how they get put together. So the Vanguard life strategy fund isn't 100% passive because somebody's tinkering with it. And my guess is that that's the reason why it's not as good as simple, because simple machines are more reliable than complex machines. Now this green dot here, I've just put that in for comparison. The green dot is 75% equity pips. I just put it in there because that's comparable. So what I could have done, if I wanted to, if I go back in time and pick a version of 60-40, I would have picked 75-25, and it would have beaten Vanguard over that time. Let's just look at that chart. Okay, so this is actual real data. So here's the Vanguard Life Strategy, the UK's largest multi-asset fund. It's like 13 billion, something like that, because this is slightly old data. So here's the red line. If I'd have just bought 75% iShares MSCI World, 25% Vanguard Global Bond, over 10, and done nothing, I would have outperformed it by almost 25% difference growth over 10 years. That makes a difference. If this was my retirement fund, it'd make the difference between retiring earlier than I wanted or retiring later. Yes?
Some of those funds probably do include or have more types in stocks and bonds. Finance theory says they should do better. You should actually have lower risk than the same return. That's a crude way of stating it. So this is even worse than he's suggesting, the gap. It's really bad.
Thank you very much. Appreciate those comments. I wanted to say there's an old joke where the guy's on stage, the magician, he says, and you've never seen me before, into the audience, you've never seen me before, have you, son? And the boy says, no, Dad. So thank you for that, but you're absolutely right. Yeah, so this is just Vanguard. Now, I've got absolutely nothing against Vanguard. Vanguard, life strategy funds, portfolios, and all-in-one portfolio, they are really good options for a lot of people. This is not to diss Vanguard, because they're one of the leaders, and I use Vanguard funds a lot in general. All I'm doing here is highlighting the basic principle that passive in general beats active, even at the top portfolio level. Let's move on. Okay, so SJP, their fund, balance managed, let's just go back. If we look at the worst performing fund in this group, is this one here, J, is SJP, St James Place Balance Managed. So if we were to compare it against F, which is our 60-40, so over 10 years, SJP has delivered 68% returns, but our 60-40 has delivered 113% returns with less, pretty much equivalent volatility. Okay, so let's just look at the SJP fund quickly. Okay, this is November's fact sheet downloaded from their own website. This is a £6.5 billion fund. £6.5 billion sterling as at the 30th of September. On the fact sheet, interestingly enough, they don't have the cost of this. They don't have what they call the OCF, or the ongoing charges figure. But fortunately, it's very easy to find on the internet. So the cost of this fund is 1.64% per annum. So 1.64% per annum. And if you crank the numbers, I love this photograph. My granddad used to have one of these in his spare room when I was a kid. What a fantastic machine it was. I loved it. But it does actually have a crank on the side. I'm not sure if that's where the expression crank the numbers came from, but it'll do for me. So if we were comparing SJP versus an equivalent 60-40, two index portfolio, 60-40 would have given us over 10 years 113% growth. Remember, 100% is doubling your money. And the cost of that, so MSCI World is 0.2, Vanguard Global Bond is 0.15, so 60-40 costs out at about 0.18% per annum cost. SJP Balanced Managed Fund, over the same period, substantially less returns over 10 years, 1.64 cost based on that. So these guys are making well over £100 million a year from running that fund. So, but don't ask me to explain why their fees are so high. Can't work that one out myself. So, I'll move on. Okay, right. Let me just backstep. So what we just talked about there was just looking at a few funds and plotting them against the PIPS line, passive index portfolio line, variations of the 60-40. What I did at the end of 2022 is I looked at, so I went to the CityWire website where I could download all, and I looked at every single actively managed allocation fund or multi-asset fund available on the CityWire site, and it was over 600, in fact 601 funds. I downloaded the data and I plotted it meticulously against that PIPS line. Remember, anything above the PIPS line is great, worth investigating. Everything below the PIPS line, we'd have been better off just buying the 60-40 or a version of it. So let's look at what that data was. Here we go. So this is the actual data. Each one of these dots is an actively managed, in fact some of them, they're all active managed by default. Each one of these dots is a multi-asset fund available in the UK as of 3 years ago, and the criteria was that they had at least 10 years of data. So we've got risk along here, return up here, here's our PIPS line. How many beat our passive benchmark? 6. So only 1% of professionally managed multi-asset portfolio funds in the whole UK market at the time, with 10 years data, only 1% beat a 2-index portfolio. Then I repeated with US, slightly different numbers, a bit better because there's less home bias in the US. Australia, also rubbish. Europe, also rubbish. So I'm focusing on the UK market now, but this is just to show you actively managed portfolios should defer, at the portfolio level, multi-asset should defer to passively managed. If you can find a way to not circle around with your portfolio, start with the right portfolio and try not to touch it going forward. It's a pretty crazy. I think this is pretty crazy. I think this is absolutely crazy. But there's more, ladies and gentlemen, because all we've talked about now is multi-asset funds and all in one portfolio in a fund. How are we doing for time? Not so bad. Okay. So the Investment Management Association of the UK says that the investment management industry looks after almost £11 trillion sterling in the UK. So 10.9 trillion. That's their estimation of the asset management industry in the UK. And if you look at where they're employed, obviously not just fund managers like the funds that we've been talking about, but they're investment funds, there's pension fund managers, investment banks, insurance companies, retail banks, others, so we can see. And across the industry right now employs about 46,000 people. So it just grows up, and the employment has been growing as the assets under management grow in the industry. I'm sure that's the same everywhere. So if you've got youngsters in your family thinking about a career, you could do worse than go into finance according to this. Okay, so moving on. So I'm thinking, I've just done the research on, because I've got the data, using some software called Financial Express Analytics, which is great. I've got the data for the individual funds, but how do I look at the entire industry? How do I compare that 60-40 against the entire industry? Wouldn't that be a really cool thing to do? Yeah, so these guys, asset risk consultants, you can visit their website, are absolutely incredible. They're based in Jersey. They have the world's largest database of real live portfolio, actual portfolio performance across the UK and international markets. So this is actually from their website, and they run indices based on it. ARC indices are a set of benchmarks that reflect the real world of experience of investors that have their wealth professionally managed. So we're not talking about DIY, we're talking about professionals managing. They're based on the world's largest database of private client investment performance covering over 20 years of real life outcomes. The ARC indices allow all investors to see what good really looks like. Okay, the absolutely fantastic facility. If you're looking after somebody's money, this is a really, really great facility. Okay, so I'm just going to go on. Right, so this is, again, straight from the website. So the portfolios of the database, 350,000 portfolios from over, in fact, I think the number's about 150 plus wealth managers, 20 years of data. The money that their contributors look after amounts to about £2 trillion sterling. So it's a pretty good database. And I think with that, that's 20% of the overall market. It's a pretty good proxy for the asset management industry in total in the UK. Wouldn't you agree? That's a pretty good sample size. If they do polls pre-election, they don't ask every 20%, 1 in 5 people in the country. Okay, so £2 trillion sterling of data, effectively. So these are some of the, I've just circled some red names that you might recognize, but these are some of the contributors of data. They're serious names, you know, with, Deutsche Bank, EFG, Coutts, Evelyn, LGT, Jupiter, Lion Trust. They're all, the Quilters, Rothschilds, Rathbones. These are all the great and the good of the wealth management, the asset management industry in the UK. Vanguard contribute, Schroders contribute. So we're talking about, this is the real deal. This is proper data from some of the world's, nominally some of the world's best asset managers contributing. Okay, so how it works. The ARC they've got a really good strategy. You upload your portfolio, and the computer automatically measures the volatility, and then it categorizes it in 4 categories. If it's high volatility, it goes into the equity risk category. If it's low volatility, it goes into cautious. So you've got cautious, balanced, steady growth, and equity risk. And very approximately, in terms of the exposure to equities, we've got, so steady growth is that 60 to 80 number. Equity risk is for people who are, very adventurous, or 0 to 40 is for people. But the thing is, we're not letting the fund managers choose themselves. The system says this is the category of peer group that this portfolio should be in. Now we can analyze it against its peers properly. Okay, so I'm thinking to myself, this is a really great system. I've been using it for quite some time. It's absolutely brilliant. Anyone watching this later, if you're an asset manager, a fund manager, or a wealth advisor, check it out. I'm not sponsored, by the way. But I thought, what would happen if I uploaded, I'm using the wrong handheld here. Well, if I uploaded a simple 60-40 into the ARC database, £2 trillion worth of data, the world's largest real world performance data, and I uploaded a 60-40, 60% iShares MSCI World, 40% Vanguard Global Bond, GBP, what would happen? Are we excited yet? Okay, so you upload the website of the ARC where the data is called Suggestus. I updated this last night. I was hoping that the end of year data is out, but it's not yet. So the closest one because their indices are released quarterly, is September. So this is to September, but the data that I have is from 2012. So it's, data since 2012. So, wrong. So the front page of the report, so I called my portfolio PIPS GBP Steady Growth. It's a pure 2-index 60/40. Uploaded it. Look at this. It's rated, my portfolio is rated A. The portfolio's performance over 100, so it's 10 years because they do the rating over 10 years, to September 2024, rate is ranked in the top 10% of portfolios. The top 10% of portfolios. Now, this includes the all-in-one, the multi-asset funds, includes private banks, includes wealth managers, includes what they call managed portfolio services. All of these guys upload data, and a simple 60/40 is in the top 10%. Does that sound crazy or what? Let's move on. Okay, here's the chart. So this is one of the pages in the report that I download from my portfolio. So here's my portfolio, here's my 60/40. Remember I said my data starts from the end of 2012. So this is the index, ARC, Asset Risk Consultant Steady Growth Index. Okay, so this represents it's like a kind of an average. It represents the performance of the peer group in general. Okay, so it represents, and the interesting thing is, the steady growth sector, you've got cautious, balanced, steady growth, equity risk. The steady growth sector is the most popular. It's about 50% of portfolios, because it suits about 50% of investors. Some want more excitement, some want more caution, but this category is about 50%. So I'm guessing, with reason, that this line represents the peer group of about £1 trillion of real investors' money, absolutely trounced over the last decade by a 60/40. Let's move on. So here, let's just look at some numbers. So first quartile, so this is the top 25%, second 25%, third 25%, the bottom 25%. The portfolio, this is my 60/40, you can see. So cumulative returns over the last quarter, 1 year, 3 years, 5 years, 10 years, the portfolio is in the top quartile consistently throughout the last 10 years. So it's not like a one-hit wonder, but persistency over every period of every measured period of time, it's in the top 25. Calendar year returns, it fell into the third quarter there, but has recovered. So 2020, 2021, 2023, and year to date, this is for last year, it's in the top, again, the top quartile. This is a real portfolio that you can go out and buy online today, and you would have outperformed at least 75%, probably, in my guess, 90% of the professional investment management industry. Okay, so just to summarize, so what we're saying is a simple 60/40 2-index portfolio ranks in the top 10% of all portfolios in the volatility peer group over a 10-year period. And that includes quartiles top quartile for 1, 3, 5, and 10 for 10 years, just what I've explained. Okay, so let's just revisit our thinking man. Sorry, I'm being held. I'm running out of time. Almost done, Ren. So let's just revisit that. Why are simple portfolios more reliable than complex ones? Fewer moving parts. We're talking philosophically. Less to go wrong. Easier to diagnose and fix problems. If we choose the right ones, we don't have any the right indices to track. We don't have a problem in the first place. No expert operators required. We're not paying big money away for somebody to make bad decisions. No constant servicing, no tinkering, no adjustment, and more predictable performance. So here's a good example of someone who gets it. This was in the FT just before Christmas. This guy looks after a 1.9 pension fund for Kensington and Chelsea Council. He has delivered the best returns across the local authority industry, or if you can call it that, sector, simply by allocating 50% of his assets to a global index tracker. And he's done some property and some other stuff, but he believes he gets it. He says individual stock or fund selection hinders rather than helps drive returns, and he avoids tactical decision making. Get the passive structure of your overall portfolio right, and you can fire and forget. And I love his line, the whole asset management industry is built on the premise that they have value. Okay, so just some key points, and I'll be finishing off and maybe have a couple of minutes for questions. So first of all, it's obvious we always pay attention to costs, and I stress one of the things you read in the press, everyone says, oh, index tracking and ETFs are better because they're cheaper. No, they're better because they're passive. They just happen to be cheaper because they're passive. So the argument is about cheap. And you can test that because a lot of the underperforming active managers, even if you took their costs to zero, they'd still underperform. So passive funds are better because they're passive, not just because they're cheap, but they do happen to be a lot cheaper than active. So for DIY investors, make sure the first thing that your equity exposure matches your investor risk appetite. Yeah, and every quarter, take a look. Do you want to take some chips off the table, or are you feeling adventurous? Index tracking funds are a great portfolio core. Now, not building a portfolio here, but if my portfolio of 2 index funds beats 90% of the industry, that's probably a good place to start if I'm building my own portfolio, isn't it? Keep extras to a minimum. Avoid buying too many individual stocks. Some people like it, but don't buy too many because then you're managing a portfolio, and even the professionals can't do that. Avoid making changes for no particular reason. We have something called action bias that makes us want to make changes even though there's no good reason. Now, if somebody else is managing your money, so a few questions to ask them. Ask them how they benchmark their risk-return performance to demonstrate the value that they're delivering. Ask them to break down your investment costs, your total investment costs, and ask them to explain their portfolio strategy. If you're an investor, you can't, in a few sentences describe their investment philosophy, it's worth investigating. And with that, before I get escorted off the stage, I will say a very big thank you very much indeed for letting me talk at you. Much appreciated.